Hey everyone, welcome back to Financial Market Insights for Traders. I'm Sophia, and today we're going to dig into a topic that sits right at the core of global macro investing, but doesn't always get the attention it deserves. We're talking about commodities, and more specifically, how commodities act as a signal for emerging markets growth. Now, this is one of those areas where if you really understand it, you start to see the market differently. You stop reacting to headlines and begin anticipating shifts before they show up in the data. So let's take our time and unpack this properly. When people refer to commodities and emerging markets, they're pointing to a relationship that's deeply embedded in how the global economy actually functions. Commodities are not just things like oil, copper, or wheat. They're the foundation of production. They're the first step in almost every economic process. And because of that, they tend to move before everything else. That's why understanding how raw materials reflect macro cycles gives you a real edge. It's not abstract, it's practical. It helps you see growth, inflation, and turning points earlier than most traditional indicators. Let's start with the structural link. Emerging markets are especially sensitive to commodity prices because of how their economies are built. You can broadly group them into two types. First, you've got commodity exporters. Countries like Brazil, South Africa, Indonesia. These economies rely heavily on exporting raw materials. When prices go up, their revenues increase almost immediately. Governments collect more taxes, trade balances improve, and their currencies often strengthen. That creates a positive feedback loop. More revenue means more spending, more infrastructure, more investment. Growth feeds on itself. Then you've got commodity importers that are still industrializing. Think India, Vietnam, parts of Southeast Asia. These economies consume large amounts of raw materials as they build infrastructure and expand manufacturing. For them, rising commodity prices can be a bit of a double-edged sword. On one hand, higher prices increase costs and can push inflation higher. On the other hand, strong commodity demand often signals a healthy global economy, which supports their export sectors. So in both cases, commodities are central. But the impact depends on whether a country is primarily exporting or importing. Now here's where things get interesting. Commodities tend to move first. Before GDP numbers improve, before earnings rise, before stock markets rally, companies need to secure raw materials. That demand shows up in commodity markets early. Think of it like this. A manufacturer expects higher demand. They don't wait for sales to spike before acting. They start ordering inputs, metals, energy, agricultural goods. That increased demand pushes prices higher. Only later do we see the effects in production data, employment figures, and economic growth numbers. So commodities are forward-looking. They give you a preview of what's coming. This is why traders often watch things like copper prices so closely. Copper is used in construction, electronics, infrastructure. When its price rises consistently, it's usually telling you that economic activity is picking up somewhere. Let's connect this to the macro cycle. To really understand how raw materials reflect macro cycles, you need to map commodities onto different phases of the economy. So let's walk through that. In the early recovery phase, after a slowdown or recession, central banks cut rates, governments introduce stimulus, and liquidity enters the system. At this point, commodity prices are usually still low. Demand hasn't fully recovered yet. Inventories might be high, but this is often where the bottom forms. Prices start to turn, sometimes quietly. This is where the signal begins, even if it's not obvious. Then we move into the expansion phase. Economic activity picks up. Industrial production increases. Construction ramps up. Global trade strengthens. Demand for raw materials rises more visibly now. Commodity prices move higher, and emerging markets, especially exporters, tend to perform well. Currencies linked to commodities often strengthen too, which attracts more capital inflows. Then we hit the late cycle phase. This is where things start to overheat. Demand outpaces supply. Prices spike. Inflation becomes a concern. Commodity markets can get volatile here. Energy prices might surge. Food prices might rise sharply. Growth is still strong, but pressures are building underneath. For emerging markets, This phase can be tricky. Exporters benefit from high prices, but inflation and tighter financial conditions can create instability. Finally, we move into contraction. Growth slows, demand drops, commodity prices fall, sometimes sharply. This is where commodity dependent economies feel the pressure most. Export revenues decline, currencies weaken, and governments have less room to spend. So, by tracking commodities, you're essentially tracking the pulse of the global economy across all these phases. Now, we can't talk about commodities without talking about China. Over the past 2 decades, China has been a dominant force in global commodity demand. Its rapid urbanization, infrastructure expansion, and manufacturing growth created massive demand for metals, energy, and raw materials. When China accelerates, commodity prices tend to rise. When it slows down, prices often fall. That's why traders pay close attention to Chinese data. Industrial output, construction activity, credit growth. These indicators help you interpret what's happening in commodity markets, and by extension, what might happen in emerging markets. Another layer to this is currency markets. Commodity exporting countries often see their currencies move alongside commodity prices. If oil prices rise, oil exporting countries may see their currencies strengthen. The same goes for metals and mining economies. This matters because currency movements affect inflation, capital flows, and debt. In many emerging markets, a significant portion of debt is denominated in foreign currencies, often US dollars. So if a local currency weakens while commodity prices fall, it can create serious financial stress. Debt becomes more expensive to service, inflation can rise, and economic conditions tighten. This is how commodity cycles can amplify financial cycles. Now let's talk about inflation and policy. Commodities feed directly into inflation, especially energy and food. When these prices rise, consumers feel it quickly. Central banks have to respond, often by raising interest rates to control inflation. But here's the challenge. Higher commodity prices can support growth, especially for exporters. At the same time, they can force tighter monetary policy. So policymakers are constantly balancing these forces, and their decisions can either stabilize the economy or add more pressure. Understanding this interaction helps you interpret not just what commodities are doing, but how governments might respond. Now, stepping back, there's also the concept of commodity supercycles. These are long-term trends, sometimes lasting decades, where demand consistently outpaces supply. They're usually driven by big structural shifts. Industrialization, demographic changes, new technologies. The early 2000s is a classic example, driven by China's rise. Today, there's growing discussion about a new supercycle, this time driven by the energy transition, electrification, and infrastructure investment. Think about the demand for metals used in batteries, renewable energy systems, and electric vehicles. If this trend continues, it could reshape emerging market growth over the next decade. So, what should you actually watch as a trader or investor? There are a few key signals. Copper prices are a big one. They're closely tied to industrial activity. Oil prices are another. They reflect both demand and geopolitical risk. Broad commodity indices can give you a wider view of trends. And even things like shipping rates can tell you about global trade activity and supply chain conditions. When you combine these signals, you start to see a clearer picture. Now, of course, understanding all this is one thing. Acting on it is another. If you want to track these markets, analyze trends, and actually execute trades, having the right tools matters. If you're looking for a world-class, cutting-edge, user-friendly trading platform app, you can check out crystalbellmarkets.com/platform. And if you're still building your understanding or want to deepen your knowledge, there's a great resource for that too. You can explore beginner-friendly podcasts covering trading, investing, macro, and financial markets here at rss.com/podcast/crystalbellmarkets. So to wrap this up, commodities are one of the most grounded signals we have in financial markets. They reflect real demand, real supply, and real economic activity. For emerging markets, they're even more important. They influence growth, currencies, inflation, and policy decisions all at once. If you understand how commodities emerging markets interact, and how raw materials reflect macro cycles, you're not just reacting to the market. You're starting to read the story behind it. And that's where real insight begins. Thanks for listening to Financial Market Insights for Traders. I'm Sophia, and I'll see you in the next episode.